Picture this: an unseen force, a silent conductor orchestrating the intricate symphony of our financial system. This is no work of fiction, but the reality of the Federal Reserve, often known simply as the Fed. It's a powerful entity, shrouded in mystique, yet its influence touches every corner of our lives, from the price of a cup of coffee to the interest rates on our home loans. The Fed operates behind the scenes, a silent guardian of our economic stability. In the following exploration, we'll demystify the Fed, peeling back the layers of complexity to reveal its inner workings. The late 19th and early 20th centuries in the United States were a time of unprecedented economic expansion. Industries boomed, cities grew at an astonishing rate, and technological innovations transformed society. Yet this period of progress was also marked by devastating financial panics. The absence of a central banking system meant the U.S. economy was vulnerable to financial speculation and market instability. Overconfidence led to excessive speculation, inflating asset bubbles that were bound to burst. The year 1907 etched itself into American financial history as the year the system nearly buckled under its own instability. The Panic of 1907, triggered by a failed attempt to corner the market in United Copper Company stock, spread like wildfire through New York City's financial district. As fear gripped Wall Street, stock prices plummeted, banks faced withdrawals, and trust in the financial system evaporated. Without a central bank, the responsibility of stemming the panic fell upon J.P. Morgan. Morgan's intervention, while successful, exposed a glaring weakness in the American financial system. The Panic of 1907 served as a wake-up call, highlighting the need for a more permanent solution. The specter of the Panic of 1907 lingered in the minds of policymakers and financiers. The need for a central banking institution became increasingly apparent. In 1910, a secret meeting on Jekyll Island led to a blueprint for a new kind of central bank. 3 years later, in 1913, the Federal Reserve Act was signed into law by President Woodrow Wilson. The act established the Federal Reserve System, a decentralized central bank with a unique structure. The Federal Reserve was tasked with safeguarding the nation's financial well-being. The establishment of the Federal Reserve marked a pivotal moment in American financial history. The Fed was given a broad mandate to provide for a more elastic currency and effective supervision of banking. The Fed's creation did not signal an immediate end to financial crises. The decades that followed saw the Fed grapple with the Great Depression, post-war inflation, and stagflation. Over the years, the Federal Reserve has evolved into one of the most powerful financial institutions in the world. Understanding the Federal Reserve is essential for navigating the complex world of finance. Imagine the Fed as a skilled tightrope walker, navigating between inflation and economic growth. Its mission is to maintain a delicate balance, ensuring the economy hums along smoothly. The Fed uses various tools and mechanisms, known as monetary policy, to influence the financial system. One crucial aspect is managing the nation's money supply, the lifeblood of the economy. The Fed's challenge is to find the optimal level of money supply that supports growth without fueling inflation. Understanding these tools is key to grasping the Fed's influence on our daily lives. One of the most powerful tools in the Federal Reserve's arsenal is its ability to influence interest rates. Think of interest rates as the price of money, the cost of borrowing it. Lower interest rates encourage borrowing and spending, stimulating economic growth. Conversely, higher interest rates can cool down an overheating economy and keep inflation in check. The Fed targets the federal funds rate, indirectly influencing other interest rates throughout the economy. The goal is to find the Goldilocks rate, not too high, not too low, that supports sustainable economic growth. Imagine the money supply as a vast ocean, with the Federal Reserve acting as its watchful guardian. Too much money and inflation rises, too little and recession looms. The Fed manages the money supply through open market operations, buying and selling U.S. Treasury securities. By buying securities, the Fed injects money into the banking system. By selling, it withdraws money. This delicate dance influences lending, borrowing, and overall economic growth. Despite criticisms, the Fed remains a cornerstone of the U.S. financial system, steering the economy towards stability. The ripple effect, from Wall Street to Main Street. The Federal Reserve's decisions shape our daily financial landscape, from grocery prices to mortgage rates. The Fed's influence touches every aspect of our economic well-being. We must shift our perspective from Wall Street to Main Street to understand this impact. Imagine the Fed as a stone creating ripples in a pond, affecting every point. The Fed's actions influence borrowing costs, lending practices, and investment decisions. Lower interest rates push the economy forward like a breeze in a sail. Businesses invest and hire more workers. Consumers make large purchases, stimulating economic activity. This leads to economic growth and job creation. Conversely, higher interest rates slow down the economy. Businesses become cautious, reducing hiring and investment. Consumers cut back on spending. The Fed balances growth and inflation by adjusting interest rates. The interest rate roller coaster mortgages, loans, and savings. For most of us, the impact of the Fed's interest rate decisions hits closest to home in the realm of personal finance. Whether we're applying for a mortgage, taking out a student loan, or simply trying to grow our savings, interest rates play a pivotal role in our financial lives. Understanding how the Fed's actions influence these rates can empower us to make more informed financial decisions and navigate the often complex world of borrowing, lending, and investing. Let's start with mortgages, the loans that allow millions of Americans to achieve the dream of homeownership. When the Fed lowers interest rates, mortgage rates tend to follow suit, making it more affordable for people to buy homes. Lower monthly mortgage payments can free up cash flow for other expenses, boosting consumer spending and stimulating the housing market. Conversely, when the Fed raises interest rates, mortgage rates typically rise, making it more expensive to buy a home. The same principle applies to other types of loans, from car loans to student loans to credit card debt. When the Fed lowers interest rates, borrowing becomes cheaper, making it more attractive for consumers and businesses to take on debt. This can be a boom for the economy, as increased borrowing can fuel investment and spending. However, it's important to remember that lower interest rates also mean lower returns on savings. When interest rates are low, savers may earn less interest on their deposits, making it more challenging to grow their nest eggs. The Fed's interest rate decisions create winners and losers, and it's essential to understand how these decisions might affect your personal financial situation. By staying informed about the Fed's actions and their potential impact, you can make more strategic decisions about borrowing, saving, and investing. Inflation, the silent thief in your wallet. Inflation, often described as too much money chasing too few goods, is a persistent threat to economic stability, eroding the purchasing power of our hard-earned dollars and creating uncertainty about the future. While the Fed doesn't directly control prices, its monetary policy decisions can have a significant impact on inflation, either fueling its flames or helping to keep it in check. Understanding the Fed's role in managing inflation is crucial for safeguarding our financial well-being and making sound financial decisions. Imagine inflation as a silent thief, stealthily picking your pocket each time you go to the grocery store or fill up your gas tank. As prices rise, your money buys less, gradually eroding your purchasing power. What you could once afford with $100 might now cost you significantly more, shrinking the value of your income and savings. The Fed aims to keep inflation in check, targeting a moderate level of inflation that is considered healthy for a growing economy. When inflation rears its ugly head, the Fed can step in to try to tame it. One of its primary tools is raising interest rates. Higher interest rates can discourage borrowing and spending, cooling down an overheated economy and putting downward pressure on prices. However, raising interest rates too aggressively can stifle economic growth, leading to job losses and recession. It's a delicate balancing act, and the Fed must carefully weigh the risks and benefits of its actions. The Fed's track record in managing inflation has been a mixed bag. It successfully tamed the runaway inflation of the 1970s, but some economists argue that its easy money policies in the wake of the 2008 financial crisis contributed to asset bubbles and exacerbated income inequality. Inflation remains a persistent challenge, and understanding how the Fed's actions influence this economic force is essential for navigating the complexities of our financial lives. Employment and economic growth, the Fed's balancing act. Beyond its influence on interest rates and inflation, the Federal Reserve plays a crucial, albeit often behind-the-scenes role in promoting employment and fostering economic growth. The Fed's mandate, as enshrined in the Federal Reserve Act, is to promote maximum employment, stable prices, and moderate long-term interest rates. Achieving this trifecta of economic goals is no easy feat, requiring a delicate balancing act, a constant assessment of economic conditions, and a willingness to adjust course when circumstances demand. When the economy sputters and unemployment rises, the Fed can step on the accelerator, lowering interest rates to encourage borrowing, spending, and investment. Lower interest rates can make it more affordable for businesses to expand, hire more workers, and increase production. Consumers, enticed by lower borrowing costs, may feel more confident about making large purchases, further stimulating economic activity. This increase in spending and investment can create a virtuous cycle, boosting economic growth and creating jobs. However, the Fed's pursuit of maximum employment must be tempered by the need to maintain price stability. Pushing economic growth too aggressively can lead to inflation, as businesses raise prices to cover rising costs, and consumers bid up the prices of scarce goods and services. The Fed walks a tightrope, carefully calibrating its monetary policy to find the sweet spot that maximizes employment without triggering runaway inflation. The Fed's role in promoting employment and economic growth is not without its critics. Some argue that the Fed's actions primarily benefit Wall Street and large corporations, leaving behind small businesses and ordinary workers. Others contend that the Fed's focus on stimulating economic growth has led to asset bubbles and unsustainable levels of debt. Despite these criticisms, the Fed remains a cornerstone of the U.S. economic system, tasked with the formidable responsibility of steering the economy toward a path of sustainable growth, stable prices, and maximum employment. The Fed and your financial future, navigating the tides of change. The Federal Reserve plays a crucial role in shaping our financial lives. Its decisions impact interest rates, inflation, and economic growth, affecting our ability to save, buy a home, or start a business. Understanding the Fed can help us make informed financial decisions. Think of the Fed as a powerful current in our financial ocean. Ignoring it leaves us vulnerable to its unpredictable tides. By understanding the Fed, we can navigate financial currents and achieve our goals. The power of understanding. The Federal Reserve, often shrouded in mystique and perceived as a distant force, is in reality an integral part of our daily financial lives. Its decisions on interest rates, money supply, and banking regulations create ripples that reach every corner of the American economy, influencing everything from the cost of a mortgage to the price of a gallon of milk. While the complexities of monetary policy might seem daunting at first glance, gaining even a basic understanding of the Fed's role can empower individuals to make more informed financial decisions. Just as a captain navigates a ship through changing tides and currents, understanding the Fed's actions allows us to anticipate economic shifts and adjust our financial course accordingly. Whether we're planning for retirement, saving for a down payment on a home, or simply striving to manage our monthly budget, the Fed's influence is undeniable. By demystifying this powerful institution, we equip ourselves with the knowledge to navigate the financial waters with greater confidence and foresight. The journey toward financial well-being begins with education, with seeking to understand the forces that shape our economic landscape. By delving into the history of the Federal Reserve, its structure, its tools, and its impact, we gain a deeper appreciation for the intricate workings of our financial system. We learn how the decisions made in the hallowed halls of the Federal Reserve Board ultimately trickle down to Main Street, affecting the lives of everyday Americans. As we conclude our exploration of the Federal Reserve, let us embrace the power of knowledge, the power to decipher the complexities of our financial world and make informed decisions that chart a course toward a more secure and prosperous future. The Federal Reserve, while a powerful entity, is not an insurmountable mystery. By understanding its role, we empower ourselves to navigate the financial currents with greater confidence, turning the tide in favor of our own financial well-being. If you found this information helpful, don't forget to like and subscribe for more weekly videos.